This is a case of financial statement fraud. This was a small U.S. public company. It operated principally out of Central America. A single shareholder that had a small number of shares, he sent a letter to the chairman of the board alleging that there were 6 specific undisclosed transactions that this company had participated in, and that the transactions violated federal securities laws, and that he was harmed as a result of those 6 transactions. And the allegations were directed toward the former CEO and significant shareholder. It was a publicly traded company, but it was a smaller company that had gone public by a reverse merger, so the former operator of the business still had a very substantial ownership interest into the company. But then he had sold the company, and these allegations came in after he was out of the picture. Once these allegations came in, the board of directors formed a special investigation committee. They hired counsel. Counsel hired accountants. It was Kara and I and a number of others in the firm. Then this committee was formed. The committee put the SEC on notice that these allegations had been made, and the process of what was occurring, that an investigation committee was formed, and that they would fully cooperate with them so that they didn't need to start their own investigation. Our role was to assist counsel with a particular focus on potentially misstated financial statements. There was also an underlying concern with regard to potential shareholder actions, so we were asked to consider things that could expose the company to other shareholders and also expose them to other regulatory concerns. Of course, potential diversion of funds as well. There weren't allegations of diversions of funds. Allegations were principally financial reporting related allegations, but we were asked to look into that, and of course inappropriate cash disbursements, and to look at transactions or look for transactions that might have no apparent business purpose. Again, I mentioned allegations were as to 6 transactions. We found, in fact, there were over 24 errors, irregularities, and undisclosed transactions that were material. We found quite a few more, but about 24 of them were what were elevated significantly enough to go to the attention of the SEC. As far as the potential financial statements, I'm only showing the most recent 3 years, but the 24 transactions, the ones that had the biggest financial statement impact, actually occurred 5 and 6 years earlier. So by the final 3 years, the financial statements weren't wrong by that much, but it was still wrong enough. You can see assets were overstated, net worth was overstated. Net income was understated, interestingly, principally because in years gone by, there were a lot of assets put on the books that didn't exist. And then the accounting department, like good accounting departments, they were depreciating those assets. There was a lot of depreciation expense for assets that didn't even exist. And then there were many undisclosed related party transactions. And a little bit, not exactly Enron, but one part of it was a number of undisclosed guarantees. The company tended to guarantee debts of the former CEO, majority shareholder, and his other companies without disclosing that. With regard to potential diversion of funds, we tested for evidence that the cash disbursements were or were not for the benefit of the company, for evidence whether or not they were properly documented and supported. We quantified the disbursements to the executive, his families, other known entities, his known creditors. There were cases where we saw that this former executive would have another company, and that company would buy and sell things, and when they didn't have money, he would direct this company to pay that company's bills. So we did a search for all disbursements to his other known creditors unrelated to the creditors of the company itself. What we did, we looked at 82 bank accounts, 4,000 bank statements over the period of time, 176,000 disbursements. There were 60,000 bank debits and credits, just wire transactions. And it was about $3 billion in total disbursements that we reviewed for propriety. And again, in testing the cash disbursements, you do the typical stuff. You agree them to supporting documentation. You look for financial statement classification, propriety. Then we did the task of just summarizing by payee, summarizing by significant category, concluded as to the propriety, impropriety, or somewhere in the middle of the different transactions. And then we categorized them by degree of impropriety, some being completely improper, some not so sure because there's no document, some a little bad, and then others that are fully supported. We also reviewed the books and records for transactions with no apparent business purpose. There were a lot of transactions that on the surface look like there's no apparent business purpose. So we go to the supporting documentation to see if the documentation justifies a business purpose or not. What we did identify, amongst other things, were loans to other companies that were owned by the former CEO, guarantees of debt for other companies, and that's an off-balance sheet thing. There's no place that's on your books. But there were times when there was $30 or $40 million worth of guarantees of debt for another company which weren't anywhere on the books, which obviously exposed the shareholders of this company. There were acquisitions of assets from other companies owned by the CEO, so he would have the public company buy assets from a purported third-party company which he owned, like land, and he would buy it at public company would buy that at highly inflated prices. And then he would also have the company sell assets like land, because the company had a lot of land, to other companies of his, which were purportedly third-party companies, and he would sell them for 25% of their real value, and he'd turn around and sell them again in the market. And we found some of that by seeing subsequent sales, oftentimes 2 weeks after the sale to this third-party company, for substantially more in public records. A lot of those were actually through Panama, but Panama's pretty good. You can go online and look at their transactions. And then pledging of corporate assets for the benefit of creditors. Again, he would guarantee, he would actually pledge CDs of the company for debts that he had on other companies. He'd turn the CDs over, even in fact, to the bank to be held in trust. Again, when it was all said and done, there were about 2 dozen inappropriate transactions. We worked directly with the SEC, us and Counsel. It was one of those cases where we wrestled with the concept of, do we try to protect privilege, or do we just work with them and hope for the best? The conclusions were more for the second, so we shared drafts with them, we shared our progress with them, we shared what we were finding with them. SEC got comfortable. SEC never opened up, never assigned their own investigation team. They got comfortable with everything that was done. And they ended up sanctioning the company. They sanctioned this former CEO monetarily and prohibiting him from ever being involved with a public company. And then they didn't go for jail time because he's now he doesn't live in the U.S. And they sanctioned the company by canceling the registration statements, effectively making it a private company. And it wasn't really by accident. I think the SEC was pretty happy with the investigation and the way it went. And we were candid, the company was candid in sharing with the SEC that it was their goal to go private. And they had actually previously started the process of going private. So when it was all said and done, the SEC said, okay, our sanction to you is going to be, we're going to cancel your registration statements, so now you're private. So that worked out.